In this video, we're going to have a look at the financials of McDonald's, which I believe is a company that requires no introduction. They are simply everywhere. They are the biggest fast food chain in the entire world. So let's have a look over their financials of the past 10 years. Let's see whether or not we think if we buy the stock today and hold it for a decade, can we expect to outperform the market? So moving right into their revenue numbers here, we can see a slowly decreasing trend here for the past 10 years. They posted 28 billion in revenue in 2013 and 23 billion here in 2022. And even though that might look very bleak here on first sight, there is actually partly a reason for this, and we'll get to that a little bit later on, the moment that we start looking at their EBITDA, because their EBITDA actually shows a slightly different picture from their revenue. Even though their revenue is decreasing quite a little bit here, their EBITDA is actually increasing every single year by about 1%. Now, one of the big reasons for this is because McDonald's has started to franchise a lot. As we can see here as well, their margins have been increasing from 37% in 2013 to about 50% here in 2020-2021. So what exactly does franchising mean here in the bigger scheme of things? It means that McDonald's is not directly owning many of the locations that have the McDonald's sign on top of them. Many of them are owned by local business owners who then pay a franchising fee to McDonald's for using their brand and using their products. So instead of getting all the revenue from this location, McDonald's now only gets the franchising fee. But of course, the franchising fee bears no expenses, so they can easily transform this revenue into EBITDA with a much higher margin that they would if they ran the operation themselves. So this means that the McDonald's company reaps most of the profit and not that much of the expenses. And for this reason, the decreasing revenue is not nearly as bad as you think, because they are improving their margins because of it. Debt level here for the past 10 years has been increasing by about 10% annually, where I think it's fair to say that for the last 4 years, that debt level is pretty much neutral here. They only borrowed a little bit in the past 4 years, but they also added a lot more cash here to their actual war chest. 2.8 billion in 2013, about 2.5 billion in 2022, not much of a difference there in the grand scheme of things. Their market cap, so the price on the open market, which is the actual market price multiplied by the amount of shares outstanding, has been increasing by 7.2% for the past 10 years. And this is about the average number that we can expect from any company in the S&P 500. So very much performing in line here with the overall trend line. Enterprise value is the entire value of the business. It's the moment that we take the market cap, to which we then add the debt and we subtract the cash. And because their debt has been increasing by about 10% and the market cap by around 7%, this is mostly an inline growth percentage, so we see enterprise value growing about in line with market cap here. EV/EBITDA basically tells us how many years of current earnings it takes for McDonald's to pay back the entirety of their enterprise value. For the past 10 years, we see an average number of around 16 times, where I think for the past 3, maybe even 4 years, this multiple is actually a lot higher, closer to 20 times, which, looking at their historic numbers, is a little bit overvalued, but we'll get to the price projection later down the line. Net debt to EBITDA level basically tells us how leveraged a company is at all times. We always look for companies that are around or below the 3 times ratio, which I think McDonald's is just about fitting that criteria here. They have a 3 times leverage ratio in 2022, which just about checks the box, although I would like them to pay back that debt maybe a little bit if they are able to make sure they don't exceed this threshold too much. So this then brings us over to their cash flow statement. Their cash flow here has been growing about in line with their EBITDA numbers of around 0 to 1% annually. 7 billion in 2013, 7 billion in 2022, where we did see 9 billion for them in 2021. We can also see here again, in line with what we saw in the actual income statement, that their capital expenditure is decreasing. The amount of money they have to put into the business to keep on operating it year after year after year is decreasing, simply because they don't own as many McDonald's locations, but instead they gave the licensing rights to the franchises. Therefore, the actual cost is not included into their balance sheet, but in the balance sheet of the local franchises, and therefore the capital expenditure of McDonald's has been coming down here for the past 10 years. Once again, increasing their margins. Cash flow is stable, capital expenditure is coming down. The moment that we take the cash flow and we subtract the capital expenditure, we get the free cash flow, which is basically your pro rata ownership of the company. This is all the money that's available to you as an equity owner at the end of the fiscal year. And they can reward you with this either by paying a dividend, buying back shares, buying back their debt, or doing acquisitions or expansions. Now, of course, McDonald's is expanding still to this very day. They also pay a dividend and they also buy back shares, as we can see here in the next column. 1 billion shares in 2013, 740 million shares in 2022. The only thing they haven't really done here for the past 10 years is buy back their debt, and I do think maybe now is around the time that they might actually start considering that. The free cash flow per share is what you get when you take the free cash flow and you divide it by the amount of shares outstanding, and because the free cash flow is growing and the shares are decreasing, of course free cash flow per share is increasing a lot here, 6% annually for the past 10 years. The price on the open market is actually growing around 11%, even though we saw their market cap grow by 7%. This is because of course they are buying back shares, and market cap is the multiplication of shares multiplied by the share price. And because the amount of shares are decreasing, it makes sense that the price per share is increasing faster than the market cap is. 11% annually return here for McDonald's for the past 10 years. And this is not including any dividends that they pay on top of this, which is about a 2% yield. So I think overall McDonald's has slightly outperformed the market here for the past 10 years. Their yield on average has been around the 4%, where once again we see for the last few years they are circling around the 3% instead. Also once again indicating that maybe right now McDonald's is trading a little bit at a premium here. So let's try to forecast this business into the future. What we have seen from McDonald's for the last 10 years is that they have grown their EBITDA by 1% annually. I'm going to say they might be able to increase this profit margin a little bit because we already saw a very high EBITDA number from them in 2021. I can expect them to maybe continue this trend somewhat. I'm going to give them a 2% growth annually, a growth in line with inflation, which I think is manageable here for McDonald's. I'm also going to attach the average multiple of 16 times here for McDonald's, which then gives me an enterprise value of around $220 billion, from which we then subtract the debt, we add the cash, gives us a market cap of $185 billion. Divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. Looking at that 10-year history, we can actually expect them to buy back some shares, but of course they have to do this with free cash flow, and I can't go ahead and spend this for them. They're going to have to do that themselves. This gives me a stock price 10 years from now of $250.91. And for that free cash flow method, I'm going to do a very similar thing. I'm going to grow it by 3% for the first 5 years and then 2% for the last 5 years. I'm also going to attach a yield of 4%, which is around their average yield for the past 10 years, but definitely a lot higher than in 2022. This gives me a stock price 10 years from now of $238.63. And right now on the open market, I can buy as many shares as I want of McDonald's for $289.17, which is well beyond my price estimation 10 years from now. Because combining the enterprise value method as well as the free cash flow method, I get an average share price 10 years from now of $244.77. McDonald's has run up quite a bit here for the past 6 months. Of course, there are many threats of a looming recession. And during a recession, people tend to switch towards cheaper alternatives like McDonald's, like the fast food industry. People were very much expecting this to happen, and of course, by extension, therefore, McDonald's share price rose up quite a bit here. But I think it's definitely a bit overvalued, because looking at the actual compounding annual growth rate I can expect from buying McDonald's right now, looking at the intrinsic value of the business, I expect you to make a loss of 1.7% annually simply based on the stock price alone as seen on the market. But the moment that we actually include the free cash flow per share as projected in our free cash flow model, I expect an IRR of 1.8%. On average, the market returns about 10%, so I think compared to the overall average, I expect McDonald's to be a bad investment at the current price range. But let's see what happens if the price goes up or comes down a little bit. So the moment that the price actually drops to, let's say, around $200, I still expect an IRR of around 6%, which is still very much underperforming the market here. I don't think McDonald's is anywhere close to being a reasonable buy until it enters the $150 area, which I don't expect it to do anytime soon. This was it for McDonald's. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff. And I'll see you in the next one. Cheerio!